Bitcoin ETF holdings have just hit a record high. This is one of the most powerful institutional forces driving Bitcoin, showing us the pace at which institutions are adding or reducing their exposure. When this line moves up, it means they are buying, and when it moves lower, it means they are selling. Since April of 2025, we've seen this line climb from 1.1 million to 1.3 million Bitcoin. That means nearly 20% of all the ETF-held Bitcoin has been accumulated in just the last 3 months. And this surge in institutional demand has had a direct impact on Bitcoin's price. We can see that by putting the chart of Bitcoin on top. Just as institutional accumulation began accelerating right here, Bitcoin went on a 40% rally. In fact, we saw a similar pattern unfold from September to mid-December of 2024. A sharp rise in ETF holdings during that window coincided with a 100% move up on Bitcoin. But this relationship works in both ways. For instance, between January to April of 2025, ETF holdings began to decline as institutions started taking profits. During that period, Bitcoin corrected by around 30%. So with ETF holdings now at record highs and Bitcoin beginning to stall after reaching new all-time highs, this is a critical moment to assess whether institutions will keep adding from here or start locking in gains once again. To get a clearer picture, we can look at the weekly inflows and outflows for Bitcoin. Over the past 3 months, we've seen more than $20 billion in inflows, with the majority of weeks showing strong demand. But just last week, that trend took a sharp turn. Bitcoin saw a $650 million outflow, marking the largest weekly withdrawal of capital since April of 2025. This sharp outflow can largely be explained by what's happening in the U.S. labor market. The U.S. Labor Department had initially reported that the economy added 144,000 jobs in May and 147,000 in June, but those numbers were just revised down to 19,000 and 14,000 respectively. That's a downward revision of 258,000 jobs, one of the largest 2-month corrections we've seen since April 2020. Naturally, this has reignited recession fears and raised concerns that the U.S. economy may be losing steam. And that's important because institutional demand for Bitcoin is heavily tied to the macro environment. You see, when conditions are strong and growth is stable, institutions tend to increase their exposure to Bitcoin as part of their broader risk-on allocation. On the other hand, when signs of weakness begin to emerge, especially around jobs and growth, institutions start pulling back. And if the labor market data continues to deteriorate, that could open the door to even larger outflows ahead as institutions shift away from risk assets like Bitcoin to rotate back into safety. If we take a look at initial jobless claims, it's a different story. It's not showing the same warning sign as 2001 and 2008. Although economic data is most definitely cooling, we don't think it is recessionary yet. In fact, a moderation in the labor market today can actually be constructive for Bitcoin in the near term. A softer labor market gives the Fed more reason to lean towards easier monetary policy, which tends to loosen financial conditions and support risk assets. And we are already seeing signs of that shift taking place. This chart shows the change in financial conditions across major developed markets over the past 3 months. Financial conditions measure how easy or difficult it is for money to move through the system, based on factors like interest rates, credit spreads, and liquidity. When these bars move higher, it means financial conditions are tightening, and when they fall, it means conditions are easing. As we can see, only 3 countries, Norway, New Zealand, and Australia, have seen tightening conditions since May. Every other major developed economy has actually been easing. In fact, if we look at this bar right here, representing the US, we can see that it has been easing financial conditions at a pace that's twice as fast as compared to any other developed country. For Bitcoin, this is critical, because when financial conditions are easing, capital becomes more willing to flow into risk assets, and the opposite also holds true. We can see that through this chart comparing Bitcoin's performance against global financial conditions. The green line here represents Bitcoin, and the white line shows Bloomberg's Financial Conditions Index. When conditions are loose, like we saw in 2013, 2017, and 2021, Bitcoin tends to thrive. But when financial conditions tighten, like in 2014, 2018, and 2022, Bitcoin performs quite poorly. In the first few months of 2025, financial conditions became extremely restrictive, which led to a 30% correction on Bitcoin. Since then, we've seen conditions ease significantly, and that's led to a strong rebound in Bitcoin's price. And with recent signs of US labor market weakness, there's a good chance that conditions could loosen even further, as the Fed responds to slower job growth with a more accommodative stance. So the current backdrop of easier financial conditions could be a key catalyst for institutions to continue buying Bitcoin, potentially leading to the next leg higher. Of course, that outlook could shift quickly if Trump's tariff policies spark another round of inflation, forcing the Fed to reverse course and tighten conditions again. Such a development is indeed a real risk for Bitcoin. But for now, our base case is that financial conditions will continue easing over the next few months. One of the biggest reasons for that comes down to global liquidity. This chart shows the year-over-year change in global liquidity. When this line is above zero, it means the global money supply is expanding, and that expansion tends to ease financial conditions and create a tailwind for risk assets like Bitcoin. We can see that more clearly by adding the chart of Bitcoin on top. Historically, periods of sharp expansion in the global money supply have aligned with some of the most aggressive rallies on Bitcoin. Today, the yearly growth in money supply is sitting above 8%, which tells us that central banks are injecting massive amounts of new fiat into the system. And this level of monetary expansion has only occurred 3 other times since 2015, here, and here. In 2016, Bitcoin rallied 100% in 4 months. In 2017, it surged 200% in just 2 months. And in 2020, it melted up by 300% in 4 months. That's an average return of 200% in the 2 to 4 months that followed. Now, with Bitcoin being a multi-trillion-dollar asset today, we don't necessarily expect another 200% rally in the next 4 months. But a strong move up from here towards the $150,000 to $200,000 region would fit well within the data. And just like us, it seems institutions are also paying close attention to these improving macro conditions, which should be a key driver for more Bitcoin demand from here. That's why we still hold an active long position on Bitcoin on our website, with our most recent entry at $107,000. And we're in fact looking to scale up our exposure further. We've been taking our clients step by step through this crypto bull run, sharing our trade setups and strategy through 3 weekly premium videos. In just the past year, our crypto trades have delivered some incredible returns, including a 30% profit on Bitcoin, 36% on Solana, and even an 83% gain on Ethereum. If you want to follow all our trades in real time, make sure to join us using the link below.